Oh, it's Jeff Christian from CPM Group. It's about 10:12 on Friday morning, the 17th of December here in New York. I'm going to talk today. We were planning to do two last videos this year. One today on how to effectively invest in precious metals, and one next Tuesday on, what have we learned in 2021. The how to effectively invest in precious metals came from questions or comments attached to previous videos that CPM Group has done, when people said, okay, you've told us a lot about how the gold market works and the silver market works. How do we effectively invest in precious metals? Because a lot of them aren't doing very well effectively. Then after last Friday's video, we had one comment, which was, so if money supply and inflation aren't driving gold prices from $250 to $2,000 to $1,800 over the last 20 years, what does cause the price of gold to rise? And somebody else said, hey, that's a really good question. Could you do a video on that? So my thought initially was to do both topics, responses to both questions or comments or requests today. It's going to be too long. So we're going to do it in two parts. And today I will talk about how to effectively invest in precious metals. And then part two will be the continuation. It's obviously a closely related topic. What does cause the price of gold to rise? And we will post that at some point between the 21st of December, when we do our last video, and January 4th, which is the first business day of next year. And we'll do a video on that day because it's a Tuesday. So that's what it is. Now, before we start, some background. I used this chart last week, and I pointed out that on an annual average basis, gold will be about $1,800 this year, and that will be a record. It'll be about 2.5% higher than the record price last year, which was the previous record at $1,755. And that, you can see, is higher than the previous annual average record price, which was in 2012. Intraday prices got higher in 2011, but on an annual average basis, 2012 beat 2011. So we're already at record prices. Second point is, again, look at the optimal allocation to gold. You can see that as you add gold to a diversified portfolio of stocks and bonds, what you find, T-bills actually, in this chart, you see that the risk declines as you start to add gold to it, but the return actually increases. And then you get this parabolic turn where you start seeing the risk rising again, and the return continues to rise too. And this is all based on actual data on a 12-month rolling basis from 1968, when gold prices were freed. This says 2016, but it actually goes through 2020, the data on this chart. 25 to 30% of your portfolio was the optimal allocation historically. Doesn't mean that, past performances and doesn't necessarily indicate future performance, but a lot of people were shocked because from 1968 to 1980, it was 5 or 10%. But everything that's happened since 1980, and we've had record stock markets, we've had record bond markets, but even in the face of record stock and bond markets, having 25 to 30% of your assets in gold actually outperformed having less gold in your portfolio, and it had a reduced risk relative to performance, and that's important to remember. Now, first rule: these are markets. I'm going to bore you and repeat these things. These are our intermediate term gold recommendations. CPM Group makes gold buy and sell recommendations for investors. We make other recommendations that are more complex for industrial corporations, producers, refiners, smelters, fabricators. We project from the next 2 weeks to the next 10 years for most commodities, gold and silver included. And Platinum Group metals, we're actually running our projections out to 2050 right now for platinum, palladium, and rhodium. But these are our intermediate term on the next 2 or 3 years. When we tell you to be buying or selling, these are our buy and sell recommendations since 1980. And you can see From 1980 to 2000, it was buy, sell. And the majority of the time it was sell or be short or be neutral gold. 2000, November of 2000, we issued a buy recommendation. We kept it until January 2012. We issued a new buy recommendation in the middle of 2013, and we've kept that in place from a 2 to 3 year time perspective ever since. And doing so gives you superior returns. If you just bought gold in December of 1980, when we started keeping records, just bought physical gold and held it, you would have, I guess, doubled your gold. But if you had bought when we said bought and sold and gone short when we said gold short, you would have had a 13% annual return on your gold, which leads to this enormous return. And a very similar situation for silver. Buy and sell, buy and sell. 2005 or so, we said go long. 2011, we said go short. 2019, we said go long. So the first issue about effectively investing in precious metals is understand these are markets, and real markets rise and fall, right? Not because of no nefarious suppression of the price, because commodity prices and other asset prices rise and fall. And that's a very important thing to remember when you're investing in these markets. Don't get caught up in this nonsense that prices will only rise, and that if those people who are predicting very sharply higher prices are wrong in their predictions, it must be because the market's suppressed. No, it's not that the market is suppressed. You'd be worried if the prices only rose or only fell, but these are normal markets. This is how normal markets behave. And don't be deluded by people who tell you otherwise. It's one of the first rules of being how to effectively invest in precious metals. Now, the next rule is empirical reality beats invalid theories. You can call them theories, you can call them beliefs. When I first met Alan Greenspan in 1981, he was running Townsend Greenstead Consulting Company. Jay Aaron, which was the company I was working for, had them as consultants. The consultancy contract ran through the research department, so ostensibly he was working for me. And he came through, I was very impressed. We spent a day talking, and at the end of that day, Herb Coyne, who was the chairman of Jay Aaron, asked me what I thought of Alan, and I said, he has one blind spot, but overall, Alan's strength is he doesn't believe in theories. This was 1981, so you had monetary theorists going around, supply side theorists, neo-Keynesian theorists, and Alan was a data hog. He collected enormous amounts of data, and he made his estimates of where the economy was going based on the evidence in front of him, the empirical evidence. This is how many cardboard boxes manufacturers are ordering, which suggests that they think that the demand for their products are going to rise or fall. Empirical reality trumps, sorry about that, bad word choice these days, invalid theories. And over the course of these videos over the last year or two, we've covered a lot of ground discussing the relationships between gold and silver and platinum and palladium and things like inflation and money supply and real GDP and currency markets. And a lot of people have a lot of theories and commonly accepted truisms about how gold and silver fit into the global economic and financial world. And they don't hold up to statistical scrutiny or theoretical reasons or empirical evidence. So it's kind of important to not believe stuff if you want to invest effectively. You need to look at what's really happening at the market. If you have a theory and it's been proven not true, or it's not been proven true, the reality is that a theory cannot be proven with any amount of evidence, but it can be disproven with one piece of evidence. If you have a theory or a belief that hasn't come true for years or decades, it's probably wrong. So think about that when people tell you, hey, silver is going to be $100 by April. Oh, no, no, no. I didn't mean that when we said we'd squeeze the silver market, that the price would rise, but the silver price is going to be $50 by December. It's a little bit over 24. It's 24.70 as we speak right now. It might get to 25 this December. There's probably less than a 5% probability that we'll see $50 this month. So, hey, if you hear someone or if you have a theory that has been consistently not proven true, it's probably wrong. At CPM Group, we say that if our analysis points to an outcome in the market and the markets do something else, we assume our analysis is wrong and we start our research over again. We do not assume the market is wrong. And that is a very important thing because you'll find a lot of people who self-delude. I'm smarter, they'll say. They'll think they're smarter than all of the thousands of people who actually have economics degrees and have decades of experience in the market. And if they're wrong, well, the market must be rigged because they couldn't possibly be wrong. Yeah, I grew up in a Catholic household, so I understand that way of thinking, but it's not a good way to make money as an investor. So the markets aren't rigged. Get that out of your system. The markets are not illogical. You may not understand the logic in the market, but there's a logic there. Maybe different from yours. Okay, a little bit of marketing perhaps, but invest based on knowledge. Do not invest based on beliefs. Effective, successful investing starts with really good research and analysis of the macroeconomic, financial, political, and social environment and the fundamentals of whichever commodity or asset that you're looking at. The big four virtues of intellect are knowledge, gather information, know what you're talking about. Intelligence, how do you think critically about that and analyze it in an intelligent way, not to confirm your bias, but to come to an unbiased conclusion as to price direction. Don't have illusions and don't be deluded by others and avoid that self-delusion I was just talking about. When do you buy gold and silver? Always. You should always own gold and silver, some amount. You can vary it depending on the economic and political environment in which you're living at given times, but you should probably always have some of your wealth, 25 to 30% in gold, according to that optimal allocation chart. You should always have some of your wealth in gold and silver. And gold, by the way, far outperforms silver on the allocation data. That's something that maybe we'll pull up on January 4th and look at that. And sometimes you should hedge your wealth. And I'll get back to that because I think that's the end of this presentation about effectively investing in precious metals. So even when the skies are blue and there's a new economic paradigm and we're not going to have inflation or recessions or a rising or falling stock market, you should still have some of your wealth in gold and silver. And you should own gold and silver, A, to diversify your wealth, to reduce your exposure to a single currency, and to diversify your portfolio of investments. So how? Given that they both serve different functions, there's some differences in how you stash each metal. Some portion of your wealth should be in gold and silver as an insurance policy against catastrophic events, either globally or in your country or in your region or in your personal life. Catastrophic event might be a revolution, it might be a failure of a country, it may be a bankruptcy of your bank, it may be a broken leg in a broken down car at the same time personally. And you should have some of your wealth in an insurance policy, physical, gold, and silver. Another tranche should be a longer term investment. If you think about it, you're a person, but you can think like a country. Countries have central banks. Central banks have monetary reserves that include gold. And those things, it's like, what's the investment horizon of a central bank? it doesn't have an investment horizon. These are monetary reserves. This is their insurance policy. This is stuff they may need in a crisis. But governments also have sovereign wealth funds, and those are investment companies, often owned by the central bank, and they have an investment horizon of 3 to 5 years. Some of them have 10-year investment horizon. So another tranche, you can think the same way. I have some gold that I'm just holding it. It's my insurance policy. I'm not looking to buy and sell it. I may hedge it at some point, and we'll get back to that. But there's another tranche that I'm holding as a 3 to 5 year period investment or not. And that's where you look at the economic environment, the fundamentals, and you say, I think gold's going to rise in the next 3 to 5 years, so I'm going to add to my position. Or you say, I don't know that gold's going to rise in the next 3 to 5 years, so I'm going to lighten up my position a little bit. And then a third portion might be what we call opportunistic or trading positions, which are even shorter term buying and selling. What do you buy? We like to think about diversifying your portfolio within the diversification. Precious metals are a diversification of your portfolio. And then you take that diversification into precious metals and you diversify it. So you own physical gold and silver. You might add platinum and palladium there, depending on who you are, how much wealth you have, and your risk appetite and your risk reward profile. But we mostly focus on gold and silver. Coins, to some extent, are good, but larger value holdings should be in good delivery or kilo gold bars, or good delivery gold bar, silver bars, 1,000-ounce bars. There's no reason, if you're going to be buying 2,000 ounces of silver, there's no reason to have 2,000 1-ounce coins. You might have 100 or 300 1-ounce coins, and you might have a 1,000-ounce bar. Futures and options are good for shorter term investments. They're more opportunistic investing. We use options a lot. We like options. We use them as our core or base position, but we also use them to hedge core or base positions. Gold ETFs or gold index notes or silver index notes, those are good too. They're very easy to buy and sell. They make a lot of sense from an opportunistic perspective, and they also are good for that core investment too, for holding it elsewhere. Not the insurance part, but the secondary investment portion. The insurance part, you want to hold some of it yourself and some of it at reputable non-bank depositories in your country or offshore. And CPM Group has a cottage industry of helping people wade through, well, what's a good reputable non-bank depository? And which ones are good, which ones are to be avoided, which ones are cheap, which ones are expensive. We help investors locate where they're going to hold their metal. And from time to time, it shifts. We used to use one particular depository company, which was great. It was a privately owned Swiss company. They sold themselves to a US corporation. And a lot of investors said, hey, it's not what we want. We want a non-bank, non-US depository. So they moved their metal to a different place. And that's okay. How much gold and silver should you own? Some people think it's a percentage of your wealth. I showed you that chart before, 25, 30%. Depends on who you are and how much wealth you have and where you are in your life, where you are in your career. Are you retired? Are you not retired? That is one way of thinking about it. It's an important way of thinking about how much it should be, but it's not the end all and be all. It's not the final decision as to how much gold and silver you should own. In Asia and other parts of the world, you'll find people not saying, what percentage of my wealth should I have in gold and silver, but what percentage of my consumption? How much money do I spend to live in a given year? And how much of that should I have in gold and silver? And you find this kind of thinking more common in places that have been racked by wars and changes of governments and currency system collapses and stuff like that. It's all important to have, but it's not the end all and be all. and hedge your positions. Now, what does it mean to hedge your positions? Let's say that you're long gold. Let's say that you were long gold at $1,600, at $1,200 at the beginning of 2019. And the price rose to $1,800. And at this point, you're looking online and all these people are telling you it's going to be $10,000 by Christmas. You can hold that gold and you can buy some puts or a put spread. We actually prefer a put spread to a put. And that allows you to continue to participate in the profits if the price rises. But if the price comes off, because remember that chart, the price goes up and down all the time, you can actually make profits in your hedge, your put. I did this in 2008 with a client who we were helping him buy a lot of gold. $700, $750, $800, $900. And in early 2008, in March of 2008, when Bear Stearns went bust and was pawned off on JP Morgan, the price of gold spiked up to 1,000. And he called and said, should I continue to buy? And we said, no. And we had done this remarkable job for him in that we had kept saying, yes, buy into a rising market, which is antithetical to the way we like to buy low and sell high. He likes to buy low and sell high. He was saying, do you really want me to keep buying at 700, 750, 800, 900? Do I keep buying? And we kept saying yes. At 1,000, we said, no, stop buying for now. We think the price of gold is going to drop back below $900 in the next 2 or 3 months. And so stop buying for now, but buy puts. Buy $900 calls. Buy puts, buy $900 calls. Or not $900 calls, buy puts. And we'll keep monitoring it. And the price of gold, in fact, fell to $900, a little bit below $900. He sold those puts back. He made roughly $100 an ounce on his hedge position, insofar as he had been buying gold at $800, $900 now, let's say $850 in this example. He made $100. He reduced his net effective acquisition price by $100. So he hadn't bought at $850, he had bought at $750, effectively, if you want to look at it that way. You know, accountants will argue all day long about whether or not to do that, but that's one way to look at it. So one of the ways you can profit more effectively in investing is by hedging your position. Maintain your long position, but buy a put or buy a put spread and go down. And similarly, if you've gone short and the price has fallen and you think, well, maybe this is the bottom, but maybe I'm wrong because I've been calling the bottom for the last 20 years and it just keeps falling, you can buy a call or a call spread. Now, that means you have to learn about options. You have to put in the time to understand options. You have to probably trade options on a paper basis, just as a dummy portfolio, to get to know the pace and everything. Because options are, it's one of those things that people misquote. Warren Buffett said, options are financial dynamite. And he did say that. And dynamite can be used to build things, bridges, foundations, towers, and it can also blow your head off if you don't know what you're doing with it. And Berkshire Hathaway actually does use options, but they know what they're doing. You've got to put the time in to work on that, to really understand what you're doing. And the way to do that is you have a dummy portfolio and you practice. So you get to see what really happens with options, because you have all sorts of things in terms of the premium pricing, the time decay, and other issues to pay attention to. And then when you're comfortable, you can roll into it. Or you can hire somebody to do it for you. We've done this in copper, gold, silver, platinum, palladium, oil, for our clients for years, helping them hedge their positions using options, or building an options position and using physical or futures to hedge it when it's moved. But this allows you to profit from those short-term adverse price moves, those moves against you, while maintaining your long position or your short position, depending on which way it is. You can maintain your core or base position. You can profit from the adverse move, and you're still benefiting if the price moves in the direction you think it is. That's all I've got for today. We are purveyors of real research. We don't sell precious metals. So our clients hire us because they make money based on our advice and our research. And we have a lot of research that you can buy. You can start with our yearbooks. They're $160 each. It's very funny because I saw one of the comments in a recent video say, you know, CPM Group's yearbooks are really great, but they're too expensive for most people. Well, that's like what, 5 ounces of silver, 6 ounces of silver at this point. It's a fraction of an ounce of gold. If you're going to be investing in gold and silver, $160 is not expensive. Now, that said, we've had institutional investors who have come to us and said, we're thinking about investing in a vanadium mine, maybe $400 million. But CPM Group, you guys know vanadium, talk to us, advise us, show us vanadium supply demand price projections, what the vanadium market really looks like, and help us, you know, consult us as to whether or not $400 million investment in a vanadium exploration property makes sense. And we say, okay, we want $80,000 for that project. They go, we're not going to spend $80,000 on research and analysis to see if a $400 million investment makes sense. Doesn't make sense to me. We have yearbooks. We have a retail investor program, which allows retail or smaller investors to plug into our research and consulting services, including our shorter term gold and silver trade recommendations. We have quarterly open forums. We will determine the first quarter's one really over the next 3 weeks or so. So by early January, we'll know what it is. But our first quarter is looking really crowded right now. And you can watch an introduction to CPM Group on our website or on YouTube. As I said, our first quarter is looking very crowded. We have our 3 yearbooks coming out in the first half of the year. We have a Platinum Group Metals online seminar in January, an Energy and Metals seminar in February. The prospectors and developers will have a silver seminar as we did this year, and we'll have a silver reception. And then we're working on the future of gold physical seminar here in New York in April in conjunction with the IPMI. So there's a lot that you can do. You can read about us on our website, cpmgroup.com. And at some point, we will let you know that we've posted part 2. What does cause the price of gold to rise? And I'll give you a little preview. That's the wrong question. The right question is, what does cause the price of gold to rise or fall? If you're an objective investor, you want to know what causes the price to rise and fall, not just rise. In the meantime, take care of yourself, have a good weekend, and we'll talk to you on Tuesday.